Hello, class. Hope your week is starting out well. Um, as you're aware, this is our final week, and we've got our final presentations that we're going to be putting together, and then our final pitch. Um, as far as our decks, we should be, if you've been keeping up, you should be relatively completed here. Basically, what we're going to do is talk about one kind of final slide, of which the content we've talked about previously. I'll go through a few things. And basically we insert that into our deck, and we're pretty much done. If you need to kind of refine the story, um, make sure it's coherent, make sure that you've got all the elements, make sure it's concise, that you've got imagery on slides, those types of things. It's probably worthwhile going back through the final deck. If you look at the point totals, is worth quite a bit compared to the weekly updates. So, it's probably worthwhile going back through that and just kind of giving it a little bit of a refresh. But generally, that deck, shouldn't be too bad. The final pitch, I'm going to go through. I'm actually going to bring up a video and that we'll watch, and kind of get some concepts from that. I think there's a lot of information detail that can go into pitching. So rather than kind of doing it on the spot, we'll take a look at a prepared video and talk briefly about what we're going to want to put together for that pitch. There is no critique this week, so you submit, I'll provide some critique and feedback back to you on that, and then we're done. So hopefully being done is just really a starting point for quite a few of you. And my hope is that you have a takeaway that you can, continue pushing forward and growing your entrepreneurial career. So let's take a look at our final slide that we're going to put together and kind of go through what's on that and how to think about it. So if we go through our pitch deck, we've got our title slide, we've got our problem solution, we've got our target market, customer persona, prototype, or kind of our traction, our value prop, and our team slide. And kind of the last one that I've inserted in here is our business model. So we talked a little bit about this before, but this is, this is just trying to root a little bit of reality into the business and help explain how do you make money and kind of what is the growth potential of this business. So that's really what we're trying to do here. Just this is presenting, have you thought about what this business is, how it would work, how you'd try to charge people? And often this doesn't necessarily need to be fact. This can be, hey, this is what I think I'm going to do. And, we've talked about this 5-step philosophy of running little experiments to test, if we can make something happen. Or if something's working, this could be a test. So maybe we think, for example, our business model is we're going to charge $100 per child per day. Well, I don't know, maybe it should be 50, maybe it should be 150. But we're going to test and try 100 and gain uh, evidence, and then push that forward. Maybe it needs to be 9 to 5 coverage. Maybe it doesn't. Maybe materials are included. Maybe they aren't. But we're gonna place our bets. We're going to do it in a way that's measured. And depending on how that goes, we'll tweak and tune and, change that model. So I'm going to talk about model and why these types of stats are important in a second. The second part you'll see below that is some information around market sizing. So there's two kind of pieces. This top part here, that's talking about what are we charging and what are we delivering? And then down here is what is the potential of who we can deliver it to? Okay. Those are the two kind of portions. So let's talk about this top part up here. So, when it comes to what I'm actually providing, 9 to 5 coverage, all materials included, in some respect, this is business dependent. So you're going to need to come up with trying to explain real quickly, kind of like what are you providing? If you're providing furniture, maybe it's flat pack furniture, flat pack delivery and flat pack hardware and delivery included or something like that. You know what I mean? Uh, uh, so shipping and all the pieces parts are included, but they need to provide labor. Makes it kind of crystal clear. The part that maybe takes a little more math um, to really be grounded, you could definitely just pull a number out and put this on the slide, and I'm not going to know any different. But you know, uh, maybe I'll explain if you want to do this the right way, how you should go about it versus just slamming a number on to get the slide done. If you want to do that, that's okay, but I think there's benefit in doing it the right way. So if you remember maybe two lectures or 2 or 3 lectures ago, we went through and we talked about, it was the financial week, and we went through and we talked about building a business model that started with analyzing our business on a month-to-month basis, taking a look at our revenue, subtracting out those excuse me, those costs, both our fixed and variable, and kind of arriving at what our profitability looked like, and then basically being able to graph this and seeing kind of when our break even point was. Well, on our business slide, this is really, the model is it's important. And if you were presenting to investors, that may be supplemental information that they ask for. The reality is man, there's a lot of detail in here. It's forecasting, so it's not like fact. It's just like, hey, this is what I think is going to happen. There's not a ton of like really great information in here. It's a way of conveying kind of how you're thinking. But this is based in some amount of facts. And the top line here is when we think about our unit analysis, well, I'm going to charge $100, right? That's what I'm going to charge. So when we build this model, I could change this number to like 125, and that would change my kind of financials about, how I think about how this business grows. So we kind of want to, the reason we build this model and we pick our unit costs and then we project how our unit costs will impact our business is we kind of want to do this juggling act of saying, okay, if we look at this specific model, here, let me blow this up a little bit. Let's see. That's a little bit better. All right, there we go. So if we look at this model, I've got my unit costs here. So I'm going to charge $100 a student. It's going to cost me $50 to serve a student. Well, my equation here is not right. It should be plus, which might impact something. We'll see. No, it's plus there. So, okay, sorry. I just had something wrong here. So, we're gonna charge our customers $100 per child per day, right? We're going to, or maybe this was on a month basis, whatever. We're going to charge $100. It's going to cost us $50 to serve that business, which gives us a $50 profit. And then as we project that into the future, based on our number of customers times that revenue, this is how our business grows, and this is how our costs grow, and therefore, we're profitable in month 3. And we can reasonably get there because we've invested $10,000, and we basically, because of we don't dip below the money in our bank before we get to profitability. All right. That's the reason the business model is important. We're basically trying to say, okay, I've got this amount of money that I can invest. It's going to cost me this amount to get to the point where I can be profitable based on my revenue. And that's a risk. That's a reasonable risk that I'm willing to take on. If you can't, if you can't kind of the purpose of doing this financial planning is, I think if you recall, maybe in lecture one of the things I said is the job of an entrepreneur is actually to reduce risk, not increase risk. And this financial model, if we have a financial model that shows that we don't have enough money based on our assumptions to get to the point of profitability, we are just running into a black hole, and that's a lot of risk. So the reason we're putting together these projections and really thinking through how does this business going to work is we want to reduce the risk on us and investors. And if you're the only investor in your company, man, that's a lot of risk. So you should really want to be certain, right? So this is how we're putting together getting this one number that then we're going to put on this slide. Okay. So we're going to do all this work around a financial model, put it on that one slide. I wanted to show another business that's um, that's different, but maybe it'll give you a secondary view. And I haven't looked at this in a little while, so there might be some tweaking that we need to do here. Let's see if we got, okay, so we've got our, okay, so this is for a burrito. This is for a burrito business. And we're going to take a look at, we've got some upfront capital costs, and then we've got a unit analysis, and then an operating model that projects that cash flow forward. And I'll share this so people can take a look at it and modify it if they'd like. But as you can see here, we've got some fixed costs, we've got some variable costs. So we've got some one-time costs required to start up the business. We've got some variable costs that you can see that we've, got monthly, and then we can total those into an annual. These are one time. And then we've got our total, we've added a contingency. So to operate this business for a year, just on costs, it's going to cost us, roughly $50,000 investment. So obviously, like, this is an annualized cost. So we don't pay this out initially, right? I'm just saying on a annualized cost basis, it's going to cost us roughly $50,000. So, depending on your level of risk on, well, when do I think I'm going to pop to profitability? You may say, yeah, I need to have $50,000 to be able to make sure I can push through a year. You may say I need to have $100,000 to make sure I can push through 2 years before I'm going to get to profitability. But obviously, when we bring in revenue, that's going to lower kind of it's going to lower that delta between how much money we basically need to invest in this business. And we'll see that in a second. Now, I've done a unit analysis here based on what I perceive as the supply. So this is how many burritos I can basically make, and this is a demand analysis on what I think the demand of the market is. And we've done we've broken our cost analysis down into units. So each veggie burrito requires, 1 unit of beans, 1 unit of beans, 1 unit of rice, no units of chicken or steak, and 2 units of veggies, and so on and so forth. And then we've got our unit costs, and basically we come to an analysis on what price we're charging, and then the profit margin, which gives us, so we've got our prices. This is what we're going to charge, and then this gives us the average profit per burrito. Now, the reason these are in green, I actually ran like an optimization formula on this to basically optimize the supply based on the demand and the costs. So I'm not getting into that in this class, but just as a heads up, there's a kind of an optimization of figuring out, okay, how many should we make, basically based on profitability. Don't worry about that too much. What's important is that, we know our prices, we know we've projected what we think the demand is, we projected what we should make, And, that lands us into, okay, this is how many I'm going to sell. This is how much money I'm going to make. And, that's the average profit. Um, okay. So again, those are the types of numbers that we put on our business model here, explaining what we're actually how our business is going to operate. So then the last part of this model is then we take that and we basically project it onto, this monthly tracker showing us, okay, how many units do I think I'm going to sell? So I've got my cash, I've got my kind of burn. So I've got those fixed and those variable costs. So you can see. So I've got my cash, I've got how many units I sell. I multiply, um, those units by the amount of profit I make per burrito. I subtract out my costs, and that ends at, whether I'm in profit or like profit or loss. Okay, so you can see here, I've got no units sold in month 0 because I'm just, doing the initial spend of the things that I um, um, of my capital expenses. And then in month 1, I'm starting to sell, and I sell 50 burritos in month 1. Times that 525 in profit means I'm making $262 in profit from my products, but I've still got my rent, right? So when I offset that, I'm losing $2,737 that month. And you can see as our business grows, like basically it takes us till month 9 in order to get to profitability. And what we can see then on our graph, when we graph that cash analysis, is there we go. There's the bottom point. In month 9, I'm going to start recouping money back into my bank account. So, I started with $50,000 on cash. I got down to like $25,000. So I've got a safety factor. I've got a margin that, hey, if sales didn't grow, so you see this 40%, that's basically I'm saying month 1, I'm going to project 50 burritos sold, and then I'm going to grow that at 40%. Month on month, basically. So let's say that growth rate is lower. Say that growth rate is like 30%, let's say. So if it's 30%, like I'm going to increase slower. And what you're going to see is that dip's going to get lower, right? So now I'm down to $20,000 in my bank account. And, you know, it looks like the bottom's at about month 11. All right, so you can see if that growth rate's slower, that bank account's going to get lower and lower and lower and lower. So that's basically, we're kind of putting a safety factor on, okay, how much money do I need to start this business? What's the risk? Those types of things. And then every month when we look at this, we can compare, okay, what happened in reality to um, what were my projections, and how comfortable am I feeling? Do I need to adjust my business in order to um, in order to increase the longevity of my business. Okay, so that's the analysis we're doing to arrive at this one number. Now, like I said, this course isn't necessarily about putting together a business model, but I think it's important to give you information that, like, I'm not really just picking this number out. Now, in order to accomplish this slide, if you're unable to kind of put this thing together and you want to just think through what number should be on that slide, that's okay for this slide. But as you build your business, I want you to understand that, like, these things aren't just things we pick out in the air. We really think about, you need to think deeply about this so that you're picking the right number, and you can understand how that number is going to impact business. Now, the number that I'm charging on child per day, that may be a number I just pick out of the air, but we want to inject that number into a model of how we kind of view the world, and then see, hey, is that model accurate? Is that number that I'm picking out of the air that seems to be working or doesn't seem to be working? Um, am I understanding the world correctly around kind of that number that I'm picking out of the air? All right, so hopefully that wasn't too crazy or confusing. Now let's talk about this part down here. So you see these concentric circles, kind of one getting bigger, bigger, bigger. This is market sizing. So we're trying to convey to the person that's reading this slide, how big can this business become? How many people, how many customers could we potentially serve with this business? So we've got a couple different concentric circles here, starting from the largest and working down to the smallest. So you see on the right here, we've got TAM, SAM, and SOM. TAM is the total addressable market. And basically the TAM represents the total market demand for a product or service. So it's the maximum kind of revenue opportunity available for a product or service if we achieved 100% market share. All right. So if we consider all the possible customers in a given market, that's kind of what we're talking about. So an example would be, let's say I'm launching a new type of scooter, like electric scooter. That TAM would be like all the potential possible users of electric scooters, let's say worldwide, including anybody, any age that might benefit from that mode of transportation. So we think if our wildest dreams were achieved, like, what could the addressable market be? So in our early education example, we're talking about families in driving distance with a 2 to 5 year old child. Okay, so it's got to be within driving distance because we're physical, and we're focused on a certain age segment of kids. Okay, but anybody that fits in there, it doesn't matter, income or anything like that. We don't care about that. Like, that's our potential market. All right, so the SAM then is a slightly smaller circle, and that's our serviceable addressable market. And basically, the SAM is a portion of our TAM, so a portion of our total addressable market that our product service can realistically target and serve. So it's what we think we can effectively reach through marketing and distribution channels. So with our scooter example, we basically take, instead of like all potential people, we're going to focus on densely populated cities that have the legal and infrastructure support to kind of make this type of thing happen, right? So I'm taking everybody, and now I'm saying cities, for instance. For our early education business, maybe the mentality of the customers, they need to be open to nature-based activity-based learning. So it's not all families, it's families that have a certain mentality, right? All right, then the last one is that SOM, S-O-M, which is, again, a smaller section, is our serviceable, obtainable market. So we're not addressable, now it's obtainable. And that's the percentage, or the portion of the SAM that we think we can realistically capture. So generally, it's like a percentage based on like time frame, resources, competition, those types of things that we think we could actually get of that SAM. So maybe we say, and we think we could realistically get 10% of the market, for instance. So for our electric scooter model, we're going to say, and we think we could get 10% of the electric commuter, or the urban commuter market. In this case, we're saying, I'm saying, probably could have been said easier here, but we say higher income earners able to afford service. So we may say, 10% of the market, the top 10 income earner, percentage of the market for our early education business, something like that. All right, so we're starting large, niching down further. That's our serviceable market, and that's what we're kind of gonna initially go after. So as you can see here, we've talked about our beachhead market previously. Our beachhead really is then a sliver a narrow sliver of that SOM. All right, so we've got TAM, which is the largest, SAM, which is slightly smaller, SOM, which is smaller yet, and then a sliver of that SOM is our beachhead. So we're going to wedge in, and then we open that up. So if you think about like a wedge coming in, and then that wedge kind of opens into that circle, that's how to think about the beachhead that opens into the SOM, that then expands into the SAM, that then expands into the TAM if we are, so lucky that happens. All right, so again, the way we kind of get these numbers is research. This is totally research based. Again, the point of this class isn't to put a research project on your desk. So, using tools like ChatGPT to estimate these types of things, um, um, you know, uh, honestly, I want you to put something on paper. So even if you're pulling it out of air right now based on your best guesses, that's acceptable for submitting this. But I want you to put some thought into it's more beneficial to try to define what the TAM, SAM, and SOM is for your business versus having the exact right numbers. So really think about how I define these things, and then you can figure out the numbers later as you grow into your business if it's too difficult to do so. Okay, so that's what we're going to put together this week, and hopefully that gives you again a good launching point for really starting thinking about your business. So I want to talk briefly about the pitch that we're going to put together. And the pitch that we're going to put together, I'm actually going to play a video that's going to really go into the details of what I want you to produce and the key elements that are in that. And we're going to watch this video. There's one slide that I want to show you. Let me see why I don't have it. Okay, so we're going to take a look at this video, but these are the key elements that I want in your pitch. And I'll talk briefly about what we want in your pitch. So we're going to do one pitch that incorporates all of the elements that we've talked about. Now, that doesn't mean you need to go from slide A through slide 8. Slide 1 through slide 8. You don't need to just follow this and talk about each slide. You can do this naturally, organically. The goal is to talk about your business in whole. And what you'll see here are these are the common elements of a seed stage pitch. We haven't talked about stages of investment in companies, but seed stage is just a initial kind of concept of a business, and that's where most of the people in this course are. And what this presentation is going to talk about is pitching to investors and raising money. But even if you're not going that route, these concepts are still valid. So these are the key pieces that I want in your pitch. And the goal is that we're going to put together a pitch that's less than 5 minutes long. And to be quite honest, the shorter, the better. The only caveat that I would put in there is if you're getting out of this in about 15 seconds, you want to make sure that you've taken the breath to convey the information that's here kind of, as best you can. So we want it less than 5 minutes, but you also want to cover each one of these points and talk clearly and authentically about each one of these areas. So the elements we want in our pitch are: 1, what do we do? 2, who's our team and why is that important? 3, our traction, and the video will talk about the traction element and how to talk about that even if you're a brand new business. Our unique insights, so like the why us, why our product, what's different, those types of things. The market sizing, which we just talked about, and then lastly, our ask. Okay, so the ask may be, I want you to raise money, I want you to come to my website and buy something. There's some sort of ask that's coming from your pitch. So When you are putting your pitch together, I want you to think about who are you presenting to. You can, I know we're submitting this to a class, but I want you to put yourself in the frame of reference when you're doing your pitch of who am I talking to, and deliver your pitch that way, and then make your ask at the end. Okay, so those are the pieces that we're going to put into our pitch, and we're going to record that, and that's what we're going to upload and have graded. Okay, so I'm going to play this. I will also post a link to this specific video. And once this is through, I'll come back on and just say a couple final things. But yeah, if you're not aware what Y Combinator is, Y Combinator is one of the most successful startup incubators. So basically, they help very early companies get to the point of bringing in capital investment. They've funded, a lot of the largest startup companies there are. So a lot of these principles are kind of like, they're very like Silicon Valley focused. That doesn't mean, so the businesses we're discussing don't need to be like in that style. But the way they go about raise money and the way they communicate, I think is quite effective. So our businesses can be very different. These principles of pitching, I think, are pretty ubiquitous, which is why I'm going to be playing this. All right, so we'll go on this, yeah. So I'm gonna start this and turn off my video and let it go.
All right, so I'm here to talk to you about something boring and horrible that every single founder hates.
Sorry.
How to pitch.
We'll restart.
All right, so I'm here to talk to you about something boring and horrible that every single founder hates. How to pitch your company. We just got through demo day and helping over 200 companies pitch investors. And pitching investors is basically the most painful thing that companies do. What I find fun is that any founder you talk to can remember every single investor who said no to them. And they hold a special kind of, I don't want to use the word hatred, but they hold a special something for those people, and they desire to prove them wrong. And so what I wanted to do today is give you all the tips that we give YC companies to be much more successful at fundraising when you are pre-product market fit. And that's really important. This is not for raising Series A's. I assume most of you here are pre-product market fit. And so what I hope to do is get you to unlearn some of the fundraising advice that you've learned so far, which is probably wrong. That's my goal. So number one, you stand out by being concise and easy to understand. I've done, I think it's over 2,000 YC interviews. And one of the things that founders don't understand is that if I don't know what your company does, I can't fund you. The number one barrier to not knowing what your company does is you. Not me, not the world that's oppressing you, not your users, not your advisors, it's literally you. A lot of people think that they need to bring a bunch of energy and pizzazz and sizzle and shark tankiness to a pitch. You don't. You actually stand out by being concise and easy to understand. And so a lot of what I'm going to do today is going to not sound fancy because it isn't. It just works. There's a talk over there that tells you about all the fancy things that don't work. So if you want that talk, you can, I'm just joking. All right. So these are the common elements of a pitch. These are the things that you need to be able to talk about. What do you do? What does your company do? Who's on your team? What's your traction? What do you know that everyone else doesn't or would disagree with you about your unique insights? What's your market size? And what are you asking for? This is a pitch. That's it. So let's start with what do you do? You need to be able to say what your company does in 2 sentences, and you need to be able to give a specific example. So let's use Airbnb as an example, right? So Airbnb lets any home or apartment owner rent out their apartment online. Sentence 1. They collect the payment online and take a, let's call it 15% fee for every booking. That's sentence 2. That's it. A lot of the magic comes in the example. And I'll give you a real world example. Imagine that you're a waiter who lives in Washington, D.C., and it's 2009 and the Obama inauguration is happening in town and every hotel room is booked. You can make $2,000, $3,000, $4,000 by renting your apartment out. And that's the amount of money you need to pay your rent for the next 2 or 3 months. All you have to do is take some photos of your place and put a listing on Airbnb, and Airbnb will handle the payments, will get you a great guest, you give them a great experience, and you've got your rent paid. What's interesting about that example is it's specific. You can imagine a waiter. You can imagine them being in DC. I don't know how old you all are, but you probably remember the Obama inauguration or the fact that Obama was president. You can imagine the hotel rooms being sold out. And you can imagine somebody being able to rent their place out for a lot of money and pay their rent for a lot of months. That is a great example. What I didn't do was I didn't give a vague example. So let's talk about where people go wrong. 1, they pitch something or they explain what they do in a way a customer would understand, but an investor would not. For most of you, investors are not your users. You use jargon with your users. You assume a lot of common experience with your users. If your investor is not your user, they don't have that experience. You have to use simple language that they will understand, not complicated language that makes you sound smart. So one thing we tell YC companies is you need 2 different answers to what do you do. One that you give investors and another one you give customers, and they're different. The words on the front page of your website are for customers. If you're using that for investors, more often than not, you're doing it wrong. Number 2, they try to be 100% accurate. There were a lot of details I left out of Airbnb in that 2-sentence description with the example, but it was clear and easy to understand. Your goal should be 80% accurate, 100% clear, not 100% accurate, 50% clear. I talked about an example that's too general. What I could have said about Airbnb is, for example, if you are in a place that has a big event and you need to pay your rent, you can rent your place out and then you can pay your rent. Same basic story, none of the little facts that make it stick in your memory and make you understand. Next up, in their example, they don't illustrate the problem and solution, right? I talked about that waiter. Inherent in that is that waiter doesn't make very much money and they need to pay their rent, and Airbnb helps them pay their rent. So instead of having a complicated problem solution slide, I just told you what the problem and the solution was right up front. And then last but not least, and this is one that I think a lot of founders screw up, you do not want to leave the first slide of your presentation without investors knowing what you do. So many founders have the first slide of their presentation with a nice logo on it, and they say like, blah, 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 and then they move on. And investors are sitting there saying, I have no fucking idea what this company does. And now I'm looking at graphs and charts and shit, and I have no idea what's going on. Don't do that. One thing you can actually do is just ask. Hey, so now that I've explained what we do, Do you understand? Or would another example be helpful? You can do that. It's really simple. Next, your team. People screw up the team slide all the time. The purpose of team is really just to talk about who's on your team, what do they do, what their impressive accomplishments and credentials are. And if possible, how they've personally experienced the problem. If we go back to Airbnb, they could literally talk about how they were starving startup founders who couldn't pay their rent. And the first time they did this, they set up a website for a design conference, hosted 3 guests so they could pay their rent. If you can weave how you've experienced the problem into the team slide, suddenly I think of you as an expert. Now, what do people screw up? No titles. I don't know what the roles are. I don't know who the CEO is. If I'm an early stage investor, I'm trusting the CEO with money. If I don't know who they are, who am I trusting? Number 2, who writes code? Number 3, telling long stories. The team slide is not the opportunity to tell your life story. Here's a hint. There is no opportunity in your pitch to tell your life story unless the investor asks explicitly for your life story, and you should double confirm they want to hear your life story. No life stories. And then, the one I always love, missing specific accomplishments. There's one company in this batch that literally worked on the Mars rover. The founder was worked at JPL and built software to make the Mars rover project actually happen. Didn't talk about it. I didn't even know when we accepted him. I'm in office hours with him a month, 2 months into the batch, and I'm like, what'd you do at JPL? And he's like, oh, have you heard of the Mars rover? I'm like, yeah, I'm not a fucking idiot. And he's like, yeah, I did. And I'm like, can we talk about that, please? If you've done something cool, say it. Without the life story, just say that you did the software for the Mars rover. It'll be impressive. Next, traction. Everyone's got this traction concept a little mixed up. For traction, you do a clear explanation of what you've accomplished since you started working on your company. And only use a graph if the graph is up to the right. What people screw up with traction all the time is that you can have traction if you're pre-launch. You can have traction if you don't have a great graph. All traction is communicating is what you've done since you've started and why that's impressive. If you've built an iOS app and it's now in test flight, in the hands of 100 users in 1 month, that's impressive, even if they're not using it a ton, even if you're not launched publicly. On the flip side, if you're building an iOS app and it's been 2 years and it's in test flight with 100 users, that's not impressive. So taking too much time and not getting anything done is the opposite here. What investors are looking for is momentum. They're looking, do you get things done quickly? They're not necessarily looking for, do you have a ton of revenue or a ton of users? If they're investing in an early stage company, they know that you might not have those things and they'll still invest. If you communicate, you get things done quickly. And the only way you communicate you get things done quickly is if your traction slide includes how much time you've been spending, right? The biggest mistake YC founders make here is they say this list of things and they didn't tell me, do they do it in a month or 4 months or a year or 2 years? Without the time, I'm not impressed. Next, they put fake work. Advisors, surveys, fake work that's not really furthering their company. And then last, and here's a tricky one, you don't need a traction slide if you don't have any traction. Putting a bad traction slide is worse than having no traction slide at all. If this is week 2 of your startup, you probably don't have any fucking traction. Putting a bunch of fake stuff on that slide just makes you look like an idiot. Just don't include it. They're obviously funding the team. Just talk about the team. So fake is worthless. Next, unique insights. What are the non-obvious things you've learned about the problem, the customer, or the potential solution? This, I think, is the most intellectually interesting part of a pitch, But you only get the right to do this if I know what your company does and if I'm impressed with your team. A lot of founders try to skip to this point, and if I don't know what your company does, I can't tell whether your insight's good or not. So, when you think about unique insights, I love using Airbnb as an example. Airbnb had one that was very unique. All of the other products that came before it, that let people do timeshare and list their spaces online, didn't process payments. And as a result, processing payments in a low trust environment where you have never met the host and the host has never met you is scary. And it prevents hosts from hosting and it prevents guests from booking. Whereas if a third party stands in the middle and processes payments, both parties can trust that third party more than they trust each other, and it facilitates the marketplace working. That's an important, unique insight, but if I had said that shit and not mentioned what Airbnb does, you'd have no idea what I was talking about. Common mistakes. Your insight's not unique. If you were to survey 50% of the people in this room or greater would agree with the thing that you're saying when you say it, it's not unique. Number two, not being specific with your examples. This is another place where vagary comes in. Like, you can tell a story here about your unique insight. You can tell a story about how you learned it. If Brian was up here, he would talk about he learned this insight when he went to South by Southwest on his platform when it didn't do payments and forgot to bring money and had a super awkward experience with his host who thought he was trying to rip them off. Right? Bam, that's a real good learning. And then last but not least, not using numbers and facts. Especially if you're talking about unique insights you've learned from your users, quote numbers, quote facts. It makes it feel more real. It makes it real. Next up, market size. Everyone screws this up. Everyone thinks that the number is what's important. How big the market is most important. The reality is how you calculate the number is what's important. As an investor, I don't know how many potential users you might be able to get. You have to educate me about that. You should do that research. I don't know how much you're going to charge the users, and I don't know why you're going to charge them that much money. I don't know if there are other products that they're buying that cost this much money. I don't know how much value you're creating for them. Showing me this bottoms-up calculation of how many users and how much you can charge them and why teaches me a lot. If you teach me in a pitch, I think of you as an expert, and I want to fund experts. So, how do people screw up? They quote some report. JP Morgan said that the online e-commerce market is 120 trillion and growing 20%. It's like, who the fuck cares? You're not teaching me anything. Number two, not showing the math. Show the math. There are this number of users. We charge them this much. Show me the math. And then three, not talking about comparable products. So if we're going to replace Figma and you're pricing competitive with Figma, tell me that. Tell me Figma charges this much and we're going to charge this much. Hell, tell me you're going to charge more because you're going to create more value than Figma. But throw in a comparative so I understand why that price is that price. All right. Next up is the ask. This is, I think, the really interesting one, and I can kind of share some personal stories about this. In your pitch, you actually have to ask for money. You would be shocked at how many pitches people do and they don't ask for money. I think that it's on the order of 70%, where the pitch is done, the founder asks if there are any questions, the investor says no, the meeting ends, no money was ever asked for. Now, I want to put you into the mindset of an investor for a second. I've been an angel investor for, 7 years. There are three mindsets I have when I'm listening to a pitch. Mindset one is, I will never fund this company. Most common, we'll never fund this company. Mindset two is, I will definitely fund this company. Least common, extremely rare. Most angel investors are rich, like they don't really understand what you're doing, why your customer needs it. They just met you. Least common, I'm excited to fund this company. Category 3 that people don't talk about. If they ask me, it will be uncomfortable for me to say no, so I will write them a check. I'll tell you that in my experience, this is up to 10% of the time. I am hoping the founder doesn't ask me for money, because I largely suspect that instead of saying no, I'll say yes, because the pain of saying no is way worse than writing a $25,000 check. How fucked is that? And the only way you tap into that is you ask. You gotta ask. Put them on the fire. And this is especially true for angels. This is especially true for angels. You gotta ask. So what are the common errors? This is pretty simple. Not asking, right? Not talking about social proof. Here are the people who've invested. Here's how much we raised. Talking about who you will hire on the ask slide. Nobody cares who you will hire. They care what you're going to do with the money, and more specifically, what revenue milestones you're going to hit, or what usage milestones you're going to hit with the money. Hiring is a means to an end. The end is revenue and usage of your product. So your ask slide needs to be, we're raising this much money, and we want to accomplish this milestone within the next 18 months, or 24 months, or whatever it is. I think what's interesting is that if you don't have that goal of where you want to be 18, 24 months from now, you're not going to be good at this ask slide. So make the fucking goal. And make it something that people would be excited by. And then ask for money. All right. So we've gone through the individual elements. Here are the mistakes that people make overall. They don't order their points from most to least impressive. The format that I gave you, you can mess around with. After what do you do, which should be at the beginning, that's pretty fucking clear, and the ask, which should be at the end, that's pretty clear. The elements in the middle need to be ordered by which is most impressive. If you've got a ton of traction, great. Traction should come right after your team slide. I'm sorry, right after your what you do slide. You've got an amazing team, great. Team should come right after. I think what a lot of people screw up with these decks is they think there's some super standard format they can't leave. And they don't realize that like there is flexibility to make your most important points early. A lot of people think that an investor is going to sit down for a 30-minute meeting and give them 30 minutes of their time. It's not true. Especially on Zoom, it's very not true. You earn every 2 minutes of that meeting. If the last 2 minutes sucked, that investor's checking their email. So don't leave the good stuff till late. That's dumb. After I know what you do, put the best stuff you have right afterwards. Earn that next 2 minutes, earn that next 2 minutes, earn that next 2 minutes. Next is treating your pitch like you're delivering a book report in front of a class. Your pitch should be nothing like what we're doing here right now. It shouldn't be you are delivering and they are waiting and listening. Ideally, your pitch should be a way that you can draw them into conversation. Now, doing this is hard. Like, this is actually a very hard skill. It's a lot easier just to deliver the pitch and then ask for the grade. But what most people don't realize about investors is that you're not really convincing an investor to invest. They're convincing themselves to invest. The more they can talk, the more they can talk themselves into giving you money. And if any of you have done sales, you know that like a common sales coaching technique is to look at a call recording and figure out how much time was the customer talking versus salesperson talking. If the customer's talking 50% or more of the time, it's much more likely that they're gonna buy. If the investor is talking 50% more of the time, it's much more likely they're going to buy. So one of the best techniques is any time you see a peak of interest in any part of your presentation, run with it. Oh, you looked interested in that. Did you have a common experience? Oh, I see you funded X, Y, and Z. I think they had to deal with something similar. Like, get them talking. If the investor's like, oh, I'm really interested in this thing, and it's the third or fourth slide in your deck, just skip to that fucking slide. Don't say, oh, let's wait, like, I'm gonna get to that. Don't get me out of my order. Like, it's like, fuck you, like, get them talking. Because the more that they're contributing ideas, the more that they're making their own connections in their head about why this thing's gonna work, the more they're gonna convince themselves to give you money. So I can't tell you enough, this isn't a book report, it's not a paper, right? What's weird is that you don't really have this experience with any teachers in your life. It's not really taught in an educational environment. Get them talking. Next, not paying attention to the investor. A lot of pitches nowadays are on Zoom. You got a close-up of that person's face. And if you actually look at it, you can tell whether they are interested in what you're saying or not. If you look. I'm a really crappy poker player, but I tried this once playing poker, like spending most of the time looking at the faces of the people around the poker table and not like looking at the hand that I was about to lose money on. And I learned a lot. Investors have a ton of tells. They're not trained. They're not trained poker players who like hide their tells, put sunglasses on and like headphones and shit, right? Their face is an open book. You can tell whether they're interested or not if you're looking. And last but not least is distracting slides. I hope you noticed these slides are the most boring, basic, bullshit design slides in the universe, right? And there's a reason. I want you to look at me and not look at the cool background image on the fucking slide. If your slides are visually interesting, that means I'm not focused on you, the person I want to give money to or not. I'm focused on some designer's work. If you need a designer to build a slide deck, you're doing it wrong. And here's an even deeper, more important point. Your designer has no idea what the most interesting and important points of your pitch are. So if you hand them your pitch to design, they will emphasize the wrong things. And it's not their fault. It's your business. You understand the most important things, not someone else. So a designer is going to try to create something visually interesting. Counterintuitively, you want something visually boring. Visually boring. Remember, clear and concise, not sexy and sizzle. So no distracting slides. All right. So I'm going to try to do this live. Let me see if I can pitch YC. And that'll be tricky. All right, so what do? We're a startup accelerator. We fund early stage startups with $500,000 standard deal. And we've invested in some of the best technology startups in the last 18 years, including Stripe, Airbnb, Dropbox, Coinbase, Instacart, DoorDash, etc. That's 2 sentences. Example. When I did YC, I started a company called Twitch. It was called Justin TV at the time. We were 23 and 22 years old. We filled out an application online. We got an interview, and after a 10-minute interview, we were funded. We participated in a 3-month program with other founders where we were encouraged to build and launch our product quickly. At the end of that process, we raised money at Demo Day. And within 3 months, we had money, we had a new friend group that encouraged us, and we had reached a new top speed of productivity. And those are the things that YC provided us. That's the example. Really simple. Traction. What's a good traction stat for YC? YC has funded somewhere around 75 companies that generate over $100 million in revenue. That's pretty good. Traction slide. Team. Right now, as group partners of YC, are people who have started, funded, hired, fired, and done everything that you are going to do as a startup founder, and they've also participated in YC. So not only the best to give you advice about your startup, they're the best to give you advice on how to get the most out of YC. Most investors have never been in your shoes. Every YC partner has been. Unique insights. There are 3 unique insights for YC. They're really basic. 1, filling out an application and not needing a warm introduction gives us access to better deal flow than any other investor in the world. 2, funding people in a batch means that batch supports one another and helps one another and gives each other advantages that the competition don't have. And 3, running a demo day means that you're running a fundraising auction. And everyone knows you're trying to get the highest price for any product, good, or service, you want to run an auction. So YC companies tend to raise at a higher valuation and dilute less than when people don't do YC. Those are 3 unique insights. Market size, since YC started, there are about 40 plus tech IPOs VC backed per year that generate about $10 billion in returns per year. And ask, apply. That's the YC pitch. Not much sizzle. Clear, concise. That's the game.
All right. Well, hopefully that was helpful and insightful and gave you some ideas on what to put together. I'm maybe purposely leaving things a bit open-ended to see what you come up with and to see how you mold your pitch and best communicate your ideas on what you think you can do and what your business will look like. So that's it. I guess I just want to close by thanking you for being part of this class. Hopefully this gave you some insights into what the world of entrepreneurship looks like. I think, just some closing remarks. Entrepreneurship is maybe about a couple things. It's a whole lot of sales and it's a whole lot of product. And, we're trying to merge those and sell the best products possible. I think the other thing that I've tried to convey is that doing this job and this work is about taking small measured steps continuously over a period of time. It isn't about taking large, massive bets and hoping. It's about running experiments, learning, and moving forward. And the reality is, it is very difficult to predict what the outcome of those efforts will be. But just like, if you think about like investing in a 401k and the mentality that people give you on doing that, a lot of the advice is don't day trade, put your money in, it grows over time. And I think the same is true with entrepreneurship. In some respect, there's a hope and you have faith in the fact that your efforts, what you put into this practice will have payout at some point into the future. So I think the right mentality to have around entrepreneurship is it's a investment model. It's an investment model in yourself. And that's how we go about doing it. So I want to thank you. I hope this has been informative, maybe a bit chaotic, but that's how it goes. So I'm excited to see what you come up with, and I hope to see you in future classes. Take care.